let's first address our top story tonight right on top of this show. And this is related to the global markets. Well, US jobless claims have come in higher than expected at 2,25,000. That is for the week that ended on September 28th. And in fact, the earlier ADP data showed private sector hiring picking up in September for the first time in 6 months. However, global US indices are remaining under pressure. And that is, of course, on the back of Middle East tensions and escalations. And not just Wall Street, in fact, European indices are also trading lower, and geopolitical tensions are aiding oil prices as well. Well, Brent crude that rebounded to trade above the $70 billion per barrel mark. In fact, stock futures are drifting lower as the focus is tentatively back to the economy and the jobs report. Meanwhile, worries over the Middle East are, of course, only inching upwards. What to make of the market scenario, the global market scenario, and how the ongoing conflict in the Middle East will impact the global economy? To discuss that and more further, I'm now joined by Santosh Rao. He's the head of research and partner at Manhattan Venture Partners. Thank you very much, sir, for joining us here on ET Now. First things first here, as far as the Indian markets are concerned, we've seen the steepest drop in months as the bears took charge after erasing gains of the past 2 weeks, roughly 2% down. And that's, of course, playing out on the back of the Middle East crisis. It all ultimately depends on the expected truce between both sides, sir.
Yeah, absolutely. Good morning. Thanks for having me. Well, there are a lot of geopolitical events, a lot of cross currents going on right now. First, we have from the U.S. perspective, of course, you have this conflict going on. We don't know how far it'll go, how much it'll escalate. So that uncertainty is there. And then the election volatility is there. So we don't know where that's going as well. So as another few weeks, I think we'll get better clarity as to which way the winds are blowing. But other than that, I think things are kind of moving along. The expectations are that the Fed will cut, but not by much. There is some discrepancy as to how much Fed will do as opposed to what the market is expecting. Market is expecting a lot more. I think the Fed chair has said that he may not do it. He may not need to do it. So a lot depends on the data that's coming out this Friday, tomorrow, especially the jobs data. So if the unemployment rate ticks up to 4.3, I think that will be an issue that he will have to consider, whether he'll cut another 25 to 50 points. So I think that's the thing. I think that all this things flow into international markets as well. And that's what you're seeing. It affects all over the world. Essentially, the geopolitical is the ground zero of everything.
Absolutely, sir, and it's certainly a difficult one to predict on, when a truce perhaps will be called, because Israel has not really retaliated as of now, so that needs to be watched out for. But, sir, you mentioned about a very important point, that is about rate cuts. Now, of course, everybody is awaiting the jobs report and whether, that will push the Fed to cut one more rate this year itself. But I want to understand from you, how much of a cushion will the rate cuts now provide, given that the rate easing cycle has begun, inflation has also been softening? On the markets front, how much of a cushion is the current rate cut cycle providing?
Yeah, we have a lot of cushion, actually. The neutral rate, according to some estimates, is around 3%. And now we are at a prime of about, 4.75, between 4.75 and 5. So I think it's pretty bad. That gap is pretty big, and that needs to close to become less restrictive. But he's saying that he's not worried about unemployment or anything causing all as rates come down. He will do it gradually. He's still data dependent. He doesn't want to get ahead of this thing. So even though he implied that he's going to cut aggressively, but I think what he essentially did a 50 points, which was good. But he said, I'm not, in a recent conference call, he said, I'm not inclined to, don't expect me to just continue on that path. It's still data dependent, still not going there. So I think I'm in the camp that he's going to do another 25 basis point, and because there's another job report before the next meeting, and then probably another one. So 50 basis points totally. So we have 100 basis points for the full year. So I think that's what I'm still on that camp. The data suggests that he doesn't need to rush. So I think, and anything more will cause panic. Will give the implication that he knows something that is really bad that the market doesn't know. So at this point, 50 basis points by the end of the year total, and that's it. So he'll stop there.
And 100 basis points for the overall year is what you're hinting or suggesting at. But sir, on the inflation front, I mean, supply chain issues could be caused due to this escalation. We saw what happened during the COVID-19 pandemic, but do point out the extent of inflation now spiking, which had been softening, whether you take the United States or you take India.
Yes, I forgot to mention another thing. There are two wild cards bubbling up, which is the port strike that's going on, which is it's going to be very crippling if it's not resolved very fast. And then the recent floods that we had, those things are inflationary because we got to put money in there and build out that thing. So all those things are inflationary. So I don't think he's going to get ahead of that. He's going to watch the impact of that. So let's wait and see. So that's a big thing. Other than that, I think it'll continue. I'm sorry, I forgot your question. I kind of took a detour there, but I wanted to put that in there.
Yes,
So net,
yes.
I think that's where the issue is.
Mr. Rao, I was asking you about the inflation front. Of course, these two factors that you mentioned are only going to push inflation further, or at least will cause some worries. But there could be supply chain issues that could also be caused due to this escalation that has, that we've seen in the Middle East. But do point out the extent of inflation and how much could it spike.
Yeah, so that's an issue. That's been an overhang for a long time, and it has not really affected anything. The war has been going on for a while. The Russia-Ukraine thing has been going on for a while. The Suez Canal has been kind of with the Houthis and other disruptions. So that has been an issue. Then we had an issue with the Panama Canal. So I think the market has adjusted to the supply issue there, but that is definitely an issue. Goods inflation has been coming down, but that has the potential to spike up if we start seeing all these embargoes and not embargoes, but blockages everywhere. So a lot depends on how this thing is resolved, where this thing lands. At this point, it's a moving target. We don't know. Seem to be okay. My biggest worry is this port strike that's going on in the U.S. That's going to have an immediate effect on the prices in the U.S. So that's where it is. But inflation overall is under control. It's on a glide path to 2% that he wants over the next 1 or 2 years, and that's what he wants. It's heading there. We don't want anything to disrupt that. Something like this, wild cards like this, the strikes and the bombs and all that stuff. But as of now, things seem to be very localized, under control. But we have some margin to work on to fix that.
Absolutely, sir. And when you talk about the Israel-Iran escalation, we are also seeing that there are some talks of, some sanctions also being imposed. The G7 nations actually met yesterday, and there was some mention of that as well. But talking about oil, the price of oil has inched almost 5% up, and that has really erased the gains of these past few days. But given that the rate cut cycle, I'm coming back to that point again, how much of a stress point do you think it's going to be on the global economy? Because now let's also understand that the US is also a big oil producer.
Yes, if oil goes up, yes, that's going to be a huge impact. That's almost a tax on people. So that'll definitely have an effect. But from what I was seeing, in fact, I think Saudi Arabia was warned yesterday that the oil prices may go down to $50. But I think that was more a warning shot for people, for the OPEC members, not to cheat on the quotas that they have. But overall, I don't think there is enough supply, and US is a big supplier there. So I don't think there is a issue of shortage or prices hiking up at this point. The worst estimates I've seen is maybe another between 70 and 80. That's it. And I haven't seen any estimates of 100 plus yet, based on what's going on. So because there is enough supply, and then China is slowly coming back on, so that might add some demand there. But there is enough cushion, from what I've read from the oil experts, that they can handle the demand that's coming in.
Yes, and that brings me to my next question, sir. And this is specifically about India, particularly, which has been holding strong the market here in these past few months. And many investors have stayed overweight on the market. But now you have hopes building up on the Chinese economy after that booster shot, the stimulus shot came up. And then you have this conflict coming up. What sort of a correction are you expecting in the near term? And what do you make of the overall fundamentals of the Indian markets?
Okay, of the Indian market. Yeah, I wanted to check that. So I think the Chinese a booster shot, so to speak, This is probably the third or fourth time they've done it. We still have to wait and see. I think it's more a trading call. In the near term, you can see some spikes, but China has some fundamental issues that are not going to go away with this boost that they're getting now. So they have structural issues, debt issues, and some other issues, and the population issues and all that. So they are fighting big battles there, and this booster shot is probably kind of a band-aid over a short term, but over the long term, that's going to hang around. So I don't think you should bank on the Chinese market as an indication of a boom coming back. It's still a long way to go. The Indian and US market, you've seen the stock market is expanding is broadening. The trading is broadening beyond just the tech stocks. So I think that's a good sign. And then we needed that. The tech stocks were in a bubble, so to speak. In India, I'm sure it's going to flow into. India is a good market. It's growing at a good clip. Inflation is under control from last data I saw. So India is on a good track by itself. But of course, every world is interconnected. So they can't really be an island by itself. So anything happening in India, in US and China will definitely have an impact there. But India can run on its own, at least for a while, because the fundamentals are very good in India.
The fundamentals are very good so far as the India market are concerned, is the word coming from you, Mr. Rao. And of course, you're saying that it might be buy China, sell India, but not in the longer run, because you also have the China plus one strategy panning out. On that note, thank you very much once again for taking the time out and speaking with ET Now.
Thank you. Thanks for having me.
If you like this video, then like, share and subscribe to ET Now.